we want to raise $20 million. Awesome, guys. We hit $13 for our investors. Obviously, we've been having a pretty busy quarter, and I want to say it was probably like a lot busier to the end of the year, right?
Probably our busiest fall that we ever kind of had in the company right now, partly because of all the unit price bumps we've been doing, which existing investors have definitely been benefiting from that. And that's definitely got some buzz going on in the industry and people getting in late. I know I was dealing with investors right up until the New Year's, right till the ball dropped in New York there. So people were texting, trying to get in, which is exciting, right? Like, and that's what we're here to help out our investors make money in real estate. We have a unit price, and like Mitt said, we hit $13 right now. $13 a shares. When we started, guys, $10. So the existing investors who started at the very beginning are feeling that great benefit right now. And we announced that our $12.65 was ending. And that's why people were messaging me right up till the end of 2025 to get in to Foundation Capital. So congratulations to those guys that snuck in right at the buzzer. And now we're $13. But wait, there's always more, right, guys?
And, the $13 represents just the appreciation component of the return. There's also the 7% cash flow distribution. So if you add that in as well annually over 3 years, you're looking at another 21% from just distributions as well, without factoring in that there's drip and compounding and all of this additional return that is added in there as well.
So I think for a lot of people, they're pretty excited because they're getting really good returns while still being in stable multifamily real estate. I think in a time where a lot of people have taken their foot off the gas, we're constantly iterating and changing things up, creating additional units, forcing that rental income to go up throughout this time period, which I think has led to people coming in and investing with us, where honestly, guys, it's been a great 12 months. We've raised more than we had the previous 2 years in this past year. So we raised $5 million year to year, whereas the previous 2 years we raised only $4.2 million in total. So I think this year we want to raise $20 million. So in total we'll be at, let's say, $30 million. I think we can do it. I think if you're seeing a lot of us on social media, marketing.
If you guys are probably our existing investors watching this is when you want to go tell your friends about these returns. You can finally go tell your mom now. You're like, Mom, is this actually working? So this thing I told you about Foundation Capital at Thanksgiving, then at Christmas. There we go. We're making Canadians passive income returns on, like Mitt said, very boring asset class, multifamily. We're not reinventing the wheel. We're renovating apartments. That's
and I think what people can expect to see from us throughout the rest of 2026 is you're going to see a lot more content coming out on how we're creating additional units in our building, how we're forcing those rents up, showing more of those active renovations and conversions, and really being able to be involved with it from a digital marketing viewership standpoint. And on top of that, I think we're going to be covering a lot of acquisitions. So I know we are in constant conversations with sellers. We're seeing more deals coming up onto the market. Clearly, a lot of sellers expected prices to start going back up, but unfortunately, bond yields have continued to stay high. So if you're buying stuff, you need to be able to actively turn things over to make money. And what we're finding in this market is that all those people who got in and they rode the wave as the market was just bumping, now are caught with their pants down, and they're realizing, hey, I can't really get in. I really don't want to buy stuff right now because I don't have any certainty as to where rates will go down, and you have to do work. So the people who are willing to do the work are who's buying in the market, and we're trying to take advantage by negotiating with sellers, whether that's from a price per unit standpoint or some creative financing, to make deals make sense so that we continue to hit our 15% plus target return for our investors.
Sure. I think you raise a good point there. I mean, a lot of sellers were initially just holding on to prices from a couple of years ago, and now that some time has passed, they're slowly starting to realize that these prices are starting to come down, and you have to build in things like people are going to ding you down for deferred maintenance. You're not going to be able to charge for what the best use NOI is going to be if the buyer goes ahead and does the work and gets it up to that use. Like, no, you have to sell it as is, and then the buyer, if they're able to do that, gets that upside now. So some interesting shifts from that marketplace.
Which is funny because I know, Jeff, we were going to go look at that 12-plex in London. And then the agent came back and said, oh, we actually got that vacancy. We're going to renovate it. And I was like, what the hell? I don't want you to renovate it. I want to renovate it. I'm not going to give you the benefit of you renovating it because you're probably not going to do a good job as we are.
Or they're going to want double what the actual spend cost is, right? So obviously that would be in our advantage to get it before the person did that. But we've been getting some good deals coming across our desk that does seem reasonable pricing, specifically a 21 unit building that we're looking at. But the advantages too, what you brought up earlier, was we're also looking at ways to create more units within these buildings as well. So again, not reinventing the wheel. I'm sure we're not the first people that have ever created new units within a property, but we're looking at it at a different lens here in 2026 when we start looking at portfolios that get sent to us and such. What else can we do beyond just raising the rent? So very exciting ahead. And obviously all your investments are helping with the renovations and pushing the values up. And that's how we can hit our 8% plus targeted annual returns on the appreciation.
And so, PB, what are you seeing from the investors' viewpoint, why they're investing with us and what's making them want to top up their investments?
Yeah, I think a big thing is it's just been consistent, stable, steady returns for them. A lot, especially with a lot of the volatility that they're seeing in the stock market and other asset classes. It's a consistent reminder for them why multifamily real estate should be a sizable allocation in your portfolio. It may not jump as high as some of these volatile investments when things are kind of in a bull run, but on the contrary, they don't drop as drastically either. So it's good, steady, stable growth, which people are realizing they value more and more as they see the volatility in the markets and they see a headline change their portfolio's value overnight. I think that's been a big positive point for investors.
And great, item right there with headlines. I mean, we started this year with the banger. Donald Trump goes in, captures Maduro in Venezuela. We're hearing all this news with all this oil coming online. It's going to impact Canada. There's been a lot of people who are let go over the course of 2025. They're in transition. They're worried about their job security in 2026. I think from all of that, people are like, you know what? I need my money to keep working for me, but I don't want to have these big drops or big fears. And similar to you, the conversations I've had with investors, they're like, I know real estate works. It's stable. It's consistent. It's not a single family home where there's like an end user. It's just somebody who's not going to be buying a home. It's someone who's renting, and I'm going to get that consistently. I know we saw that headline come out of the US as well, where they're going to ban institutional buying of single family homes. So, you got all those investors who are in Canada thinking, oh my God, I've been buying single family homes in the US. Life's good because I don't own 1,000 plus. Well, guess what? Your exit liquidity is gone. The guys who were buying those houses at the thousands, the Blackstones of the world, were giving you guys liquidity. It's what also held up the market price for these units. Sure, it's great for the end consumer who's going to actually live in the home. But if you're a landlord who's like, I'm going to do it myself, or I'm going to, buy this house and have a remote property manager, well, tough luck. Single family homes don't have an institutional buyer. And that's going to drop somewhat of a floor, in my opinion, in regards to that pricing. And now those same institutional investors, they like the asset class of rentals, of single family home, of family rentals, where they're getting that residential rental income. Where are they going to go? They're going to go into apartment buildings, multifamily real estate. So just, if you can't buy this individual home, you're going to buy the bigger apartment buildings. And so we'll probably see that as something that's going to happen across both the US and Canada. And I think with all the global shifts that we're seeing, it's going to be something where multifamily might actually transition into not just a defense asset class, but a bullish asset class.
Another interesting thing is, speaking with some investors, a lot of them seem to understand that, even despite some of the scary real estate headlines they've been seeing with regards to like condos and single family homes, they're still realizing that, man, this is actually a really great time to be bullish on Canadian real estate. We still very much structurally have a housing shortage, and, the supply is not going to be able to meet the demand in the long term. So, there's a sense of urgency from investors to get invested now and ride that growth up as the market comes back and continues to explode over the next course of the next long term, right? So I think, it's interesting to see that perspective from investors. And, many of the ones bringing this perspective are busy business owners, and they realize they need to be invested, but they don't have the time to do it themselves, which is why they're turning to real estate trusts like ourselves to be able to invest passively and get those returns and have that Canadian real estate exposure in their portfolio.
And I think another aspect that you highlighted as well is they want that exposure, but the REITs that are available are becoming far from many, because we just saw Minto being taken private. And so now that's no longer an option for investors to be able to get access. So we get the question all the time, why would I go with a public REIT versus a private REIT? Well, public REITs are more liquid, but usually the returns are a lot less available, and they'll trade at a discount to what the value of the asset minus the mortgage is worth. And that's just because it's reflective of interest rates and what bankers want to trade the stock at, not what the buildings are actually worth. Then you've got private REITs. Well, you're seeing with the Minto Group being taken private, it's going to be long-term institutional money that's buying this asset class because they really believe in it. It's not going to be available to the retail eligible investors of the world. It's going to be only available for larger family offices. And so for people thinking, hey, how can I get access to this asset class that clearly large institutional wants to take advantage of, getting into private REITs like Foundation Capital Private Real Estate Trust is going to give them that advantage and that return.
Yeah, a lot of people too were nervous about headlines that rent is coming down, especially in the Toronto areas. We have investors that are selling their condos because they're seeing that kind of going down, and obviously their capital will be better off in our trust than trying to compete with the condo market. For Foundation Capital, what we're creating is more affordable units, which has been working out well for us.
Yeah, I mean, when we saw the latest CMHC report, we're seeing a lot more turnover that's happening, even from the higher renting places. So all these luxury rentals have come up online. People now, they're having to discount what rental that's available. But people who want to save money are moving into places like ours, where you're getting a brand new unit, but it's an older building otherwise, but you're getting a brand new unit, you're saving $500 a month. And that's like the difference maker versus going into a brand new building. And especially as Canadians look to tighten their belts right now and kind of stay ahead of all this inflation and other, job security, this is kind of the advantage of staying housed with us. From an investor perspective, I guess for investors, they're feeling pretty confident that, we've got our pulse on the market. I know I had one investor this past weekend send me a triplex deal in Waterloo, and he's like, hey, what are your thoughts? I think he was expecting me to say yay or nay in an email, but I actually was like, fine, let me just do the number analysis for him. So I took in where it was existing. So it's an existing triplex in Waterloo where it's owner occupied with the other two units rented at roughly where the market rent is. And they wanted $935,000 for this triplex. So I put the numbers down and said, okay, cool. You're going to be 20% down in this place. The seller says, oh yeah, you can re-rent this place for $2,200, $2,250, whatnot. I pull up the CMHC report. I see the average 2-bedroom rent in Waterloo at $1,850 with vacancies up to like 4% and at 4.1%. And on market, I'm seeing other new build units come online for like $2,000, $2,050. So I said, look, buddy, like I think maybe if you get $2,050 for the owner occupied unit, I think the other two rents right now at $1,890 and $1,950 is what true market is if you don't account for lease expense. When we ran all those numbers and we looked at everything, we said, okay, cool. If all that happens, you will get between cash flow and principal pay down, and you're not going to really see appreciation. You're at a 5% return. But if you do the property management yourself and you give yourself a second job, you get an 8.5% return. And then that investor was like, holy Mitt, you're right. Like, thanks so much for putting this into detail. It clearly makes it pretty objective for me as to why I'm not going to go out and try to buy the triplex myself and just buy it and manage it. Yeah, you might own the asset directly, but you're subject to that individual property. And I think that's what's drawing him to, take that capital instead and deploy it with us. And that's where a lot of Canadians who and business owners who say, hey, I can own the asset directly or I can buy it myself, realize that will limit their returns. So you have that shelf. Do you want to make the most amount of money, or do you want to just say you're a real estate? And do you want to be? Do you want to make money in real estate, or do you want to just say you're a real estate investor?
Are you in this to make money or be a landlord? Very quickly, you'll become a landlord if you go down that route. But Mitt, you Mr. Tech Genius developed a calculator for us.
Yes. So if you guys want to go to
Put it down
invest.foundationcapital.ca
below.
on our website, you can do it's available on mobile, it's available on your laptop. You can go ahead and play around what your investment for how long, and you can get a summary emailed to you. I know this past weekend, I guess people have been reading the newsletters and they've been filling it out and getting that email to them. If you want to see how you can make your money working for you, making 15% plus target returns annually over a longer time horizon, you can see how $10,000 invested over a 25-year period grows north of $430,000. Go check out invest.foundationcapital.ca. Get yourself your investment summary.
On that note, it's officially RRSP season. So, make sure you guys are starting early to think about using up your RRSP contribution room. The deadline is March 2nd, 2026 this year. So as you know, with FCP REIT, you can invest using your RRSP, and all of the growth within your RRSP account will be tax deferred, and you will get a tax benefit for the deduction and the contribution into your RRSP. You also have $7,000 of new TFSA contribution room to utilize as well. So while you're on that website playing with the calculator, keep that in mind that we have these tax efficient tools and ways to invest as well.
And you want to get in because you might be thinking, oh, the $13 bump just happened. I'm just going to wait. Well, we're reviewing our investment quarterly. We're going to see continuous quarterly bumps like this happening. So make sure to get your investment in, take advantage of your tax advantages, and join us and 250 plus investors for the ride of investing with Foundation Capital Private Real Estate Trust, where we're trying to become the largest real estate fund in Canada.
Awesome, guys. Keep making passive income, and we'll see you on the next video, or join our newsletter.